Okay, so morning again. I hope that you all hope. I'm just checking that I didn't unmute someone by accident. I'm hoping that you all had a good weekend and you're ready for action today. So just a reminder about where we are in our process. Today we're on the 8th of November, so we're finishing up chapter 11. We just have impairment left and then subsequent expenditures, which is subsequent expenditures, really small part of this chapter. The homework has been available on McGraw-Hill Connect for a while. So, if you haven't started that, please get going because it's due on Wednesday. Again, as usual, the homeworks count 3% of your grade for the class. And then I just wanted to alert everyone to the fact that quiz 2 and test 2 is coming around the bend here fairly quickly. That's for chapters 10 and 11. They'll open up on November the 11th, which is Thursday. That doesn't mean obviously that you have to do it on Thursday. You've got until the following Thursday to do the quiz and the test. So it's kind of the same setup as before, in that you have a week's window, and anytime during that window, you can, finish that work. I did yesterday, as part of the prep for the class, I did set up, and I just realized now that it's hidden. So let me make this available to you so everyone can see. All right. So if you are on Blackboard, or maybe you'll log into Blackboard, remember you can get there through my LaGuardia. You will see, and I don't, oh gosh, I seem to have all the wrong, I forgot to update this. Let me beg off on the first paragraph because I copied the information from test 1 and quiz 1, and I forgot to change the dates. And so I'll fix that during the break. But what I wanted to just alert you to was that I tried to go lighter on the penalties because I didn't like the way the system worked the last time. So the last time I changed it from, I think it was a 20% penalty down to 4% on the quiz. I now changed it to 2%. So you lose 2% if you go on the second attempt and another 2% on the third attempt. For the test, I changed it from a 6% reduction to 4%, so that there is an incentive to get the stuff right in the first go around, but that you guys are not being as penalized. And then the quiz is going to be 10 multiple choice questions, and I think I need to do some cleanup here because I mixed up some of the chapter 8 and 9 language, but it's really 10 and 11. But these are the exercises. So let me step away from this because I don't want to confuse people, and I'll fix it during the break, and closer to the end of the class, I'll come back and make sure that we're clear on that. But I guess the bigger point for this is that, that between November the 11th and November the 18th, at some point during that time, you'll have to find the time to do the quiz. It's still 2 hours that you have for the 10 multiple choice questions, and then 3.5 hours for the test. All right. So those are the dates. That's where we are at for the quiz. Does anybody, barring the things that I have to fix on the prep sheet, which I'll fix, like I said, during the break, does anybody have questions about the dates or anything to do with the scheduling of the quiz and the test? All right. And then the only other thing that I'll mention now, and like I said to the people who sent me papers, I have your papers. I'm busy reading them. I'm trying to finish them by today or tomorrow to get them back to you, especially if you want to do an early submission. I don't want to sit on them. I was hoping to finish them by the end of the weekend, but it wasn't possible because I had to work on the quiz and the test. And you can see I still didn't get through everything. So optional early submission of the research paper if you are so moved. Remember, the research paper is only 4 to 6 pages. double spaced, no less. So it's really not a lot of stuff that you're doing, but you do have to make sure that you answer the questions that are posed. Optional early submission for +5 points on the 17th. So, I'd said this before, and I guess now reality is setting in that, that the time is winding down to the end of the semester and that things are coming due. These dates were set at the start of the semester, so it's probably, it's not a surprise to anyone, but it's starting to feel like a lot of things are coming due. If you don't want to submit early, that's fine. You can submit the final term paper submission is on the 24th of November, and this is so that I can grade them and turn them around to you before the end of the semester, so that you can know where you stand in the class. All right. And so please don't plan to be late. The term paper is a significant portion of your grade. I just want to remind you that with the term paper, I have given you a sample APA citation papers to make sure that you are citing properly. For those people who haven't been submitting drafts, if your citation is not correct and things are not cited that should have been cited, that's a big problem. All right, that's potential massive amount of points lost or even failing the paper. Furthermore, if you maybe can't even remember what the paper is anymore, you vaguely remember that you chose a company, but you don't know, which company it is or whatever. The term paper is right here on the Blackboard site. You would have chosen one of these companies. I have a record of what everybody chose. So if you literally forgot what you chose for some reason, you can contact me. You have specific questions, that you need to answer. You need to work with the most recent annual report of the company, not a quarterly report, not, just something that you found online. It has to be a Form 10K. If you can't find it for any reason, speak to me. And you can see there's 4 bullets under each section here, and it has very specific questions that I'm asking you. I'm looking for the answers to those questions. And each bullet has points attached to it. So if you don't answer this, say for instance, this 20-point thing correctly, then that's 20 points lost. And what I mean is you decide you're running so late that you're not going to do it. I've specifically put the points potential here so that you can decide if you are really struggling to finish this, decide what you're going to do and what you're going to, God forbid if you have to, what you have to leave out. And then again, the points are split fairly evenly between 3 of these parts, and then there's analysis of 3 or 4 ratios that under liquidity, solvency, and profitability that you guys have to do. One of the people who has been doing the drafts asked me how best to present this financial highlights information. Definitely a table is better than just writing about it, but I'll accept either way. The one thing I do not want people to do, and I've had at least one person do this, is just copy and paste the financial statements from the company's annual report and just put it into your paper. That's not what I'm asking you for. I'm asking you for specific items to show whether they increased or decreased from one year to the next, right? And so a dollar change and a percentage change, and then based on that to say whether you think the company is stable, improving, or deteriorating, and why. Okay, it may sound daunting, but you're going in, and I don't know if I'll be able to find this in my let me see, if because there was, when I was speaking to someone, I actually did the table to show them. Yeah, so I'm thinking about something like this, right? If I'm asking you about revenue, here's revenue, here's the current year, maybe 2020 or 2021, depending on when the company's year ends. Here's the previous year. You say the increase, decrease in dollars, and then maybe a percentage change. And the percentage is always the current year minus the prior year divided by the prior year's number. All right, so the fastest way that you can get this done is just to make a table and then just say, based on my analysis above, I believe blah, blah, blah. I mean, I just wrote nonsense here. I'm just trying to demonstrate for you guys how to do this. But again, I repeat, do not just dump the financial statements into the, the paper and then start talking about stuff. That's not what I'm asking. I'm asking you to specifically pull out revenue numbers, pull out expenses numbers, assets, liabilities, stockholders' equity, cash flows, and earnings per share. And part of the basis of me asking you to do this is that my aim is for you to become comfortable in looking at companies' financial statements and being able to find these numbers and analyze them. That's all part of our jobs as accountants, and you'll be doing things like this for sure at your 4-year school. So for those who haven't really been thinking about the term paper, or you're a little bit maybe not feeling like you are on par, because we've got about from 16 days left before the next submission date. Just think about what you're going to do between, I don't know, if you choose to finish the test and the quiz on the 18th, then you're leaving yourself with about 6 days to finish the whole paper. That is a decent amount of time if you're actually taking time over those 6 days. But I would highly suggest that you at least read the requirements of the term paper, as soon as possible, so that you can see if there's anything that you don't understand. I did go over this with you guys at the start of the semester. I went over it, I think, one more time, and I'm going over it again. But if there's something, it's good to just print it out and read it and identify anything that you may not understand what exactly is needed, as opposed to waiting, till the bitter end and then having to contact me to try and figure out if you're doing the right thing. Okay, so November the 24th at 6 p.m., that's the final deadline. November the 17th, that's the early deadline. Questions on the term paper, anybody? Or any questions on the scheduling stuff before we move into the work? Yes, go ahead.
Hi, Professor. I was wondering if whether it's affecting to my grade if I didn't submit the part one term paper.
You mean the draft? The draft?
Yes.
The draft doesn't count. Like, there's no grade for submitting a draft. I cannot say whether your grade would have been higher or lower if you had submitted a draft for you specifically. All I can tell you is that over the years, the people who submit drafts generally get better grades because they are making whatever mistakes they are making in the drafts, and I can read the draft and correct them, right? So that's all I can say. Some people, I've had situations where people don't submit drafts and they submit a decent paper without, having submitted a draft, and it's fine. But I've also had situations where people, don't submit drafts and they submit a paper and there's plagiarism or something because they're not, they maybe even not on purpose, but they're just not citing properly, or they do things last minute or whatever. So can I say what will happen to your grade? I can't. The draft submission is an option. You didn't have to do it. But I said this before when I spoke about the draft submission, that in general, people who submit drafts are going to have higher grades because they've basically been through one round of review with me already.
Oh, I see.
So what I would suggest for you, since you haven't, submitted a draft, you're saying for Part A, is go back to the requirements for Part A and make sure that you've actually, answered the questions. That pay table or whatever that I showed you, or however you did your work, try to follow, what I'm saying, and also go to the term research paper resources and look at the citation help and make sure that you are citing your sources inside your document and on the references page. Because the biggest problem I'm finding, even with the people's work I'm reviewing, right now, and this was for Part A, is that people are giving me a whole list of references at the end of the paper, but nowhere in the paper did they cite where those references were used. And that's not appropriate citation for APA. You have to, well, for anything really, you have to show, you know, say you write, you know, some history of your company or whatever, you know, you got it from the company website. When you're done with that paragraph, you have to put the company's website as your source, and the company's website needs to appear as a source in the references page. Am I making sense?
Yeah, it makes sense. Thank you so much.
Yeah, so that's a recurring problem that I find that people don't know how to cite. And unfortunately, citation can cost you the whole paper, because if you send me a paper and there's no references inside your work, there's not even a reference to the annual report, which you should reference which page of the annual report you are referring to, then I have to deduct points like crazy. It may even end up in a failure of the paper, because I don't know what part of the paper is your writing and what part is somebody else's writing. So I have to put it through a system like SaferSign or something like that, and then it throws up all where the writing is somebody else's, and then depending on how much of the paper is actually yours, we could end up with a very low grade. So I don't want that for anybody. If anybody has more questions about how to make this paper as close to
Sir, I have a question.
Yeah, go ahead.
So 17 November, which part we have to submit the research paper?
Sorry, you have to submit your final research paper for the parts A and B together, like the paper that you're done now working on.
Okay, understand.
Okay? Yeah, so I'll send you back. I know you're one of the people who submitted your draft. I'll send you guys back your draft between today and tomorrow, so that you can incorporate any comments I may have, so that you can, if you're still aiming to submit early, then you still have time to do that.
Professor?
Yes.
I have a question. For this research paper,
yes,
do we have a specific title about the writing, or we should write all section, the part A for the 4 or 5 and the part B?
Yeah, it's just part A, part B. Just show me where part A starts and where part B starts. That's fine.
Okay, so okay, should it be part A and part B, and we need to write about all of section?
Yeah, I mean, are you asking if you have to answer all the questions?
Yes, so actually I'm a little confused because
okay, so what is your question? This is part A. You answer part A, and then you move on to part B, and you answer the questions under part B.
Yeah, and the part the total that for each section. The part A
50 points. Is that what you're talking about?
No, I mean 4 questions for part A, and the 4 or 5, I forgot. 4. 4 questions for part B. We should write 8 questions.
I mean, you're writing a paper, so it's not going to end up being 8 paragraphs or 8 questions. You have to answer every question. That could end up in many paragraphs, fewer paragraphs than. I think I understand what you're saying now. You have to answer everything, otherwise you won't get the points. But does it have to be split up into like 4 parts for part A? It doesn't have to be like that. You can start every question a new paragraph, but it might, that question might have multiple paragraphs, but I'll be able to follow which questions you're answering. I think that's what you're asking.
I understand. Me. So you mean that we need every 8 questions?
Yeah, but I don't want you to do, but I don't want bullets or something. It's a paper. So you're writing, as long as you're saying, here starts part A, I'll be able to follow what you're saying and see if you're answering all the questions. And then it's part B, but you don't have to say question 1, question 2, question 3.
Yeah,
like
understand.
That. Yeah, nothing like that. Okay,
yes.
all right.
Thank you.
Yeah, and please, guys, for anybody who's submitting, this should be standard practice, but I still see that it doesn't happen. You have to have your name on every page of your paper, because if I'm sometimes I print out the stuff and I print out multiple people's work at the same time. And either people send me work where their name is not on any of the papers, or there's a cover page with your name, but then nothing else has your name. So please just make sure your name is at the top. It can be top right or top left. It doesn't matter of the paper. And also just number your pages so that when if I do end up, I mean, it will be Thanksgiving weekend when I'm marking. I may be, marking at different times and whatever. So I might be marking physically and not on the computer. So I just am requesting that you add your name onto each sheet, so that if I'm marking stuff physically, I don't have to wonder whose work it is. All right. So yeah, mark part A, part B, write your name. You don't have to write the class and all of that, because I know that it's this class, but just make sure you identify yourself. And if you can, when you send me the document, because I also get like strange things, people send me stuff with just their name or the document has a name that doesn't really make sense or whatever. So just write that it's your term paper. That will also be helpful. I have 2 other classes that, it's not people who are writing papers, but people are sending me things. And I just want to make sure that I don't miss your work when you send it to me, all right? Because I keep all the papers in a separate folder. Okay, so that's just the reminder about the papers. Like I said, I'll fix the test info around the break, and then we'll talk about it at the end of the class. But let's just get into impairment again. We were there for a little while last week, Wednesday, but we need to just get in and make sure that this stuff makes sense to everybody. So in this chapter, we spoke about depreciation, depletion, and amortization, which is like what we said, it's a systematic and rational approach to expensing the cost of an asset based on its use, all right? Because you're not going to expense the asset immediately when you buy it, because there's future benefits. So as you use up those future benefits, the definition of an expense, this is from accounting 1 or even from your 201, is the cost of an asset that's used, an asset that's consumed, or a service that is used. So this asset is being used up and we're depreciating it. But it's possible that the conditions in the market could change, or something changes with the business that there is a loss of usefulness of the asset that goes beyond depreciation, and it's actually more significant, and we call it impairment. And I think I told you last time, if you say something is impaired, it doesn't work the way it's intended to. So you don't see it now because I'm looking at a screen, so I don't need it, but usually I wear glasses. And so that means that my vision is impaired, right? Because it's not operating, at 20/20 the way it's supposed to. So an impairment occurs when the expected, well, let's just let me just take a step back. We've got 3 scenarios for impairment that we'll cover. There's impairment of property, plant, and equipment, and finite life intangible assets. So by finite life, we mean these assets have a certain number of years that they will be around for. Then we've got indefinite life intangible impairment. Okay, that's the second scenario. So that's something, like a trademark or something like that, where the life is carrying on into perpetuity indefinitely. And then the final impairment is the impairment of goodwill. Oh, sorry, that's not the right thing. The impairment of goodwill. So we'll go through all 3 and try and see how you. Basically, the bottom line here is that you want to see how to calculate impairment, loss, and record a journal entry if there is a loss. So all of this stuff is driven by some type of test that you do to see if the asset is impaired. And if the asset does come up as potentially impaired, then you have to do a calculation to see how much the impairment loss is. So I'll repeat, there's some type of test that we do to see whether the asset is in fact impaired. And if it is possible that the asset is impaired, there's a calculation we have to make to see how much the impairment loss will be. And as you know from previous times of the FASB, they will always have you recording a loss in the period when it happens. So even though, you know, the asset for a lot of the stuff is not being sold, it's still being used and so on, they don't care about that. They just say, well, if there's a potential impairment, then you're going to have to take the impairment loss. So specifically for property, plant and equipment and finite life intangibles, an impairment occurs when the expected future net cash flows. So this is new information, okay, and it's a little bit weird. So let's make sure we understand this. We're saying when the expected cash flows that we're going to get from this asset, and net meaning cash in minus cash out, right? So the expected future net cash flows, how much cash we can make from this asset, undiscounted, which means we don't calculate the present value amount. We just say, how much cash can we get for the rest of the life of this asset? And that's the undiscounted cash flows. If that number, the cash that you can get, is less than the assets carrying amount, okay, less than the assets carrying amount. And remember, the carrying amount is the same as book value. Book value is cost minus accumulated depreciation. So this is going to be book value, which is cost minus accumulated depreciation. So that's the test that we do. And basically, this test has a name. It's called the Recoverability Test, and I'll go over it here again. But that's where you start. And if you find that the expected future net cash flows is in fact less than the carrying amount, then the asset may be impaired, and then you move on to step 2, right? Which I'll go over in a minute. How do you begin to think about impairment? You kind of have to look around and see, are there possible events that could have caused possible impairment in the asset. So, for instance, if you find that tastes have changed, you know, in the market, and people don't want a certain type of product anymore, so you may find that your machine that makes that product is not as useful anymore, or there's some type of government regulation that's preventing you from making a certain thing, that can also cause, you know, potential impairment. And that could even just be the machine itself. You know, you thought that it was going to be producing 10,000 units. Now it's only producing 2,000 units. And so there's, you know, there's something up with it. And so there's, you know, an impairment. The book goes into a lot of like potential events that could cause impairment, but it's predominantly either market related, like the market, something in the market is causing less of a demand for whatever, you know, that asset is producing, or it's internal, that the asset itself is failing in some way. If the events do indicate impairment, then you do the recoverability test, which is this comparison of the expected future net cash flows to the assets carrying amount, right? And if there is potential impairment, then you have to calculate the loss, right? So how do we calculate the loss? Any impairment loss for property, plant and equipment and finite life intangibles is the difference between the book value or the carrying amount and the fair value of the asset, right? So in a question, and we'll do a question here in a minute, they'll tell you what the fair value is, they'll tell you what the undiscounted cash flows are, and they'll tell you the carrying amount of the book value. So there's normally 3 things that you're looking at, so you have to be careful, because in the recoverability test, you're looking at undiscounted cash flows and the book value. And then in the calculation of the loss, you're comparing the carrying value and the fair value. And fair value, as usual, is the market price for the asset. It's what you could sell the asset for. If there's no active market, then fair value is the present value of future net cash flows. For our purposes, for the most part, the question just tells you what the fair value is. If you're working in practice, more often than not, you'll be able to find a fair value of the asset. If you have to do a present value calculation, it's not that hard, because you already have all the cash flows from before. You would just have to find an interest rate to calculate present value. I'll just finish and then I'll take questions. If the impaired asset that you are, the asset that you're impairing is held for use, meaning you're going to continue using it, you're not planning to sell it, the new cost basis of the asset is going to be basically the fair value. It's the reduced carrying amount. So, you make this journal entry to eliminate some portion of the carrying amount of the asset because there has been a loss in usefulness. And even if things change and suddenly this asset becomes so attractive and everybody wants the product that you're making, you are not allowed to write the asset back up, okay? So even if the fair value increases at some point, typical FASB, typical GAAP, you take the loss, but if there's a change that would cause you to have to write the asset back up, you're not going to write the asset up. They'll just tell you, well, you'll realize those benefits through use, or you'll realize it if you decide to sell the asset. Any depreciation is taken on the new cost basis of the asset's remaining useful life. You cannot, I just said this, you can't recover any impairment loss afterwards. You just have to live with it. So clearly we have to be very careful when we do any type of impairment, because it's kind of a permanent, event. You aren't really allowed to reverse anything afterwards. And so you can imagine that companies are, not that excited about recording impairments, right? I mean, who would be if you know that the impairment is going to be a loss, so it's going to decrease your profitability. And if circumstances change in the market, there's no write-up. So questions on the theory before we try to look at some examples and see what's happening. Nothing? Okay, so what do we have to remember? Two-step process, right? As we go into an example now, it's a two-step process. The first question is, are the expected future net cash flows, so the undiscounted future cash flows, right? Are they less than what we are carrying the asset at? And at that point, we're basically saying that we are showing higher future benefits than what we can actually get. If that's the case, then the asset may be impaired. And then in step 2, we compare the fair value to the book value of the asset, and we calculate an impairment loss, and then we have to make a journal entry. Okay, so we go into example 11. There we go, impairment. All right, so this example 11 and 12 are two, of the two sides of the same coin, or however you want to say it. It's, it's just testing to see if we understand how the information presented can change the outcome of the exercise, right? So let's read here. I'll do these with you. M. Allo Inc. has equipment that, due to changes in its use, see, there's the event, right? Changes in the use of the equipment. It reviews for possible impairment. The equipment's carrying amount is 600,000. Again, carrying amount is the same as book value. It's cost minus accumulated depreciation. Allo determines the expected future net cash flows undiscounted from the use of the equipment, and its eventual disposal will be 650,000. The equipment has a fair value of 525,000. So there's a lot of numbers floating around, but again, it's really 3 numbers that you're focused on. You're looking at the undiscounted future cash flows, the carrying amount or book value of the asset, not cost, not accumulated depreciation, the actual book value, and then also the fair value. But you have to start with the recoverability test. So I'll show you how to do that. So I'm back in the Google Doc, which everybody has access to. And you also have access to the solutions, right, of all of the stuff. So step 1, right? Oops, sorry, where did that come from? So step 1 is, it's Monday. Step 1 is the recoverability test, right? So what are we asking here, right? Are the undiscounted, right, future net cash flows less than, right, the assets carrying amount? And again, carrying amount and book value are synonymous. And so when we look at the question, we see that the undiscounted cash flows are 650,000. So I'll just use an abbreviation, undiscounted cash flows, 650,000. And then the carrying amount we get from the question, 600,000. So we already know what the answer is going to be here, right? The answer is no. And then the asset is not impaired. That's the answer for A. So here you see it's possible that you can have a question that's asking you about impairment and the asset actually turns out not to be impaired, all right? And so in the B part of this question, they're talking about, and I'll go back to it quickly. If the equipment is impaired, what is the loss on impairment? And so obviously, you know, the equipment is not impaired, right? So there is no impairment loss. Questions, anybody? We only did step one, right? So no, the asset is not impaired, and I should say here, don't move on to step two, which is the calculation of the loss. Simple enough, hopefully. All right, so that's that example. The second one is obviously going to have an impairment, right? Because we have to test whether we actually understand this. So M-Allo Inc. has equipment that, due to changes in its use, all the same information, right? It's reviews for possible impairment. The equipment's carrying amount is the same, 600,000. The expected future net cash flows are 580,000 and the fair value is 525,000. So using the recoverability test again, is the equipment impaired? And so we can already kind of tell that it's going to be impaired, but I'll just take you through the motions here. So step one, right, recoverability. And what do we say? Are the undiscounted cash flows, net cash flows, less than the assets carrying amount? So, you know, just going through this, what are the undiscounted cash flows? They're now different from before, right? Now they're 580,000. So 580,000 and the, oops, and the carrying amount is 600,000. So now the answer is yes. Right, that's the answer for A. Yes, the asset may be impaired. And the reason we say may be impaired is that we still have to calculate to see if there is in fact an impairment loss by comparing the fair value of the asset to its book value. So the asset may be impaired. Move on to step two. Questions, anybody? Or something you need me to repeat? I don't want to move too fast here in case someone has a question.
Just 1 more minute to write down the.
Yeah. Please stop me.
Yeah,
please stop me if I'm moving too fast, because I'm copying and pasting things that people are actually writing. So I can wait.
Yeah, thank you.
I'll wait until 11:15 for people to copy and also for any questions or anything that you want me to explain again, just in case someone maybe got lost. Yes, my dear.
Yeah, so carrying amount and book value is exactly the same meaning?
Yeah.
Okay.
Yeah.
Thank you.
And you know how to calculate it, right? Cost minus accumulated depreciation.
Yeah. Yes,
okay.
Understand. Thank you.
All right. So I'm going to go on to the B part of this question. I think most people are probably okay with me moving on. So now in the B part, it's step 2, right? Because they ask us, sorry, let me just get back here. If the equipment is impaired, what is the loss on impairment? So that's basically walking you into step 2, which is the calculation of the impairment loss, right? And how do we calculate that, right? The impairment loss is calculated as the difference, or let's say it a different way, as the carrying amount minus fair value. So that's, I mean, if the fair value is, you know, we got to be careful. Like if the fair value is more than the carrying amount, there isn't going to be a loss. Let me just write that in case that doesn't make sense. If the fair value of the asset is more than its carrying amount, there won't be a loss, okay? Because the company could sell the asset for more than it is carried on the books. So, you know, I don't think we see it so much in our work, but remember you're going to do all this stuff again at some point at your 4-year school. So I just want you to be aware that in the first step for the recoverability test, this is why we say the asset may be impaired. We don't say the asset is impaired, because to know whether the asset is impaired, we have to compare the carrying amount to the fair value, which we haven't done yet in step 1. So in step 2, you calculate the impairment loss, but there's only a loss if the carrying amount is greater than the fair value. Okay, that's the way to think about it. So I don't know if it really matters which amount goes first. I mean, it depends on whether you want to end up with a negative number or positive number. But if you look at the carrying amount over here, just logic, right? The asset is being carried at 600,000. And the fair value, meaning what you could get for it, right? What you could get for it is 525. So clearly there is a loss, right? And the loss, you're gonna have to write the asset down by 75,000. If you're more comfortable to do it the other way, you could do it this way also. You could say, what is the fair value? It's 525. What is the carrying amount? It's 600,000. And so the loss will actually pop out as a negative number. And maybe that's easier for some people to follow, you know, that this, because it's a negative number that's going to come out, that means that it's a loss. Either way, it's the same loss. You can choose whether you want to write fair value down first or carrying amount first. You're still ending up with the same dollar amount, right, of the loss. And of course, remember that there's only a loss if the fair value is less than the carrying amount. If the fair value is more than the carrying amount, there won't be a loss. And I'll just write, we have a loss because the fair value of the asset is less than its carrying amount, okay? Important to also understand the logic of why that is. Otherwise, you may have an amount pop out when you're doing this work and you're not even sure if there is a loss. A loss will occur if the fair value is less than the carrying amount. Questions on the 75,000 or any of the thinking around how to calculate it? Okay. Part C asks us, is a journal entry required? If so, prepare the journal entry. So these questions is like they're trying to, I mean, I don't want to say to trick you, but it's kind of like they don't want to give away the fact that there's obviously a journal entry required. So they're kind of saying, is there a journal entry required? And if so, prepare it. We know that there's a journal entry required because there's a loss, right? So there has to be a journal entry required. So here goes the journal entry for a loss on impairment. Oops. Today is just a day of extra letters. The journal entry for a loss on impairment. So surprise, surprise, right? We debit loss on impairment, or no surprise there, for the 75,000. And then the credit, and this is where you kind of have to just suspend your disbelief a little bit. The credit for this equipment loss is going to go to accumulated depreciation. So, that's a little bit weird, right? Because it's not like we're actually depreciating the asset. In fact, this is, a loss of usefulness that is more extreme than just the depreciation. But I think the thinking here is, remember, when we're depreciating these assets, like property, plant, and equipment, we are not crediting the asset itself. We're crediting accumulated depreciation. So this impairment is almost being treated like an accelerated depreciation because of the loss of usefulness of the asset, right? So, I'm going to highlight this in red just so that you can make a mental note that you're actually crediting accumulated depreciation. Questions on the journal entry? Okay, so let's look at part D. It says, if a loss has been incurred, where on the financial statements will it be reported? Sorry, this E should have been below here. So where will it be reported? So we know that revenue, expenses, gains, and losses go into the income statement or the statement of operations, right? So, pardon me, if this loss is material, meaning that the number, would change people's thinking around the financial statements, then this loss will have to be shown separately in the income statement. So if it's not that material, it can go into the other expenses and losses portion of the income statement. So if the loss is material, it will have a separate line item in the income statement. Remember, income statement is the same as the statement of operations. If it is not material, it will be aggregated, so added together with other amounts in the, and this is the name, in the other expenses and losses portion or line item of the income statement. So it really depends on whether 75,000 is considered material for the company, but for the most part, it will just go. I guess the point of this question, in case you're panicking and you're like, oh my word, am I supposed to know that? The point of this question is just to make sure that you understand that a loss of this nature is not part of operating expenses, right? It's not part of your day-to-day expenses. It's something that happens, occasionally. We don't really expect it to happen, but it may happen. And so as a result, it's not going to be shown just as operating expenses. It will have to be other expenses and losses, or maybe even its own line item called loss on impairment. Hopefully that's clear. So again, if you're thinking, do I have to memorize where this goes? Not necessarily. The bigger issue is, do you understand that it's not a day-to-day item, right? That will just be part of operations. Any questions there? Okay. So next what is the new cost basis of the asset after the write-down? So we saw this in the theory. We had said that the new cost basis is the reduced carrying amount. So remember, carrying amount is cost minus accumulated depreciation. So the new basis is the reduced carrying amount. And so what, you can do it, this is the long way to do it. I'll also show you the short way. So the cost for this thing, if you go back, was 800,000 and accumulated depreciation was 200,000 before we did anything. So it was 600,000 accumulated depreciation right before we started. I keep saying 600,000, it was 800,000 cost, right? Accumulated depreciation before we started was 200,000. And then the additional accumulated depreciation from our impairment, right, was 75,000. So the new carrying amount and the new carrying amount is just going to be the cost minus these two numbers, which you will notice, right? 525. So the new cost basis is the same as fair value, because you wrote the asset down to fair value. So if the question is asking you what's the new cost basis or on what amount are we going to base depreciation now, or some question like that, you will just be able to, you don't even have to do this calculation if you don't want to. You can just, go back and see how much is fair value, and that will be the new cost basis of the asset. Why do we care about a new cost basis? Because remember, this asset is being held for use and still being depreciated. So you need to make sure that you are basing depreciation on the correct amount, right? So I'll just write here, the 525,000 is the amount that depreciation will be based on going forward. Right, that's why we care about what the new cost basis is, because we'll actually still have to depreciate this asset. Questions on part E? All right, and then F, we're almost done here. If the equipment's fair value increases to 580,000, right? It was 525, it increases to 585. Can the company reverse the previous write-down? And here you have to go back to the theory and remind yourself what it said. Later recovery of an impairment loss is not allowed. The cost basis is not written up even if the fair value of the asset increases in future years. This is for an asset held for use, okay? For an asset held for use, a reversal of previous impairment is not allowed. Okay, so it's possible if the asset is out for sale, if you're looking at fair value every year while you're waiting to sell it, that you may be able to reverse some portion of the write-down, right? But for now, let's just focus on the held for use thing here, because we're also talking about depreciation. Okay, questions A through F. Anybody, anything that you want to revisit? All right, so we've done two examples. There was one example, number 11, where there was no impairment because the undiscounted cash flows were greater than the book value. And then in 12, you went through the whole impairment process. You went through the recoverability test. You found out that the cash flows that you could get from the asset were less than the book value or the carrying amount of the asset. So you had to test the asset further to see if there was an impairment loss. In the second step, the impairment loss is calculated as the difference between the fair value and the carrying amount, right? If the fair value of the asset is less than the carrying amount, we have a loss. And there's the journal entry for the loss specifically for property, plant, and equipment types of assets. If this was an intangible, you would credit the asset itself unless they were using an accumulated amortization account, right? But if it was an intangible, you could do the asset or the accumulated amortization. And then we spoke about how to disclose the loss. It may be its own line item, or it may be in other expenses and losses. And then finally, you know, this asset may continue to be depreciated if it's being used in the company. So you have to remember that the new carrying amount is equal to fair value because the asset was written down to fair value. And if the asset continues to be used, you can't reverse any impairment loss. We'll talk about an asset held for sale later on. That asset is basically reviewed every year, kind of like a lower of cost or fair value type of review. So we'll get into that. So that's the first type of impairment testing. The second one is a little bit easier. Thank goodness, right? The second one's a little bit easier, and I'll talk about that after we come back from a break. So come back at 11:42, and we'll carry on with this work. I'll leave this page up for another minute or so in case people are still taking notes. But 11:42, we'll start again. And I'll fix the test prep paper while you guys are on break. Okay, I'm going to stop sharing now so I can just fix the test prep sheet, all right? So I took the rest of the attendance. I've also fixed the test prep sheet, so I'll go over it right at the end of class. And I just wanted to move us along here to the second scenario with impairment, which is an indefinite life intangible. So again, this is an intangible where you can't put a number of years on its life. It's just going to carry on, you know, and on. So the typical example is a trademark or some type of intangible, and we'll see this in the example that we have, that is renewable. Sometimes it's like a license for a radio station or something like that. It's renewable to the point that there really isn't a useful life in a number of years because the license will just be renewed, you know, quote unquote, forever. So that's also considered an indefinite life intangible. So it can have an indefinite life by virtue of its nature, like a trademark, or by virtue of legal means where it can just be renewed all the time. So with that being said, because this thing has an indefinite life, there's no way for you to determine how much of cash flows you can get over its life, right? Remember in the first example, we had this notion of an undiscounted net cash flows that we could use to compare to the book value. But if something is going to go on forever, you cannot really add up the cash flows that will come from it because you just don't know, right? You can't project that. So what ends up happening here is that the measurement of an impairment loss for an indefinite life intangible is just one step. It's called the fair value test. And all you ask is is the fair value of the asset less than its book value? So it's kind of like step 2 on our previous example, right? You just compare the fair value of the asset to its book value. Book value is the same as carrying amount. If the fair value is less than the book value of the carrying amount, an impairment loss is recognized, and it's recognized for the difference between those two amounts. And same thing as before, if an impairment loss is recognized, then the written down book value becomes the new cost basis for any type of further testing or whatever allocation you need to do. And you also can't recover any impairment loss. Even if the fair value goes up in future years, you can't reverse your impairment losses that you took. So again, that's why companies have to be very careful and sometimes are reluctant to take, impairment losses, because they know that they cannot recover those losses in the future. So this excludes goodwill, okay? Goodwill is also an indefinite life intangible, but goodwill has a slightly different process because goodwill comes about by virtue of the purchase of a whole business. So you can't look at goodwill as a separate intangible on its own. You have to look at the business as a whole. All right, so let's look at an example of an indefinite life intangible. And to do that, I'll skip over this one because you have the answer for this one. It's going to be similar to what we did in number 12, and I'll go straight to number 14, which is the indefinite life intangible. Okay, so Archon Radio purchased a broadcast license. So there's the intangible asset, the broadcast license for $2 million. So it's a radio broadcast. The license is renewable every 10 years if the company provides appropriate service and does not violate the FCC rules. So, they can't do stuff on air that they're not supposed to be doing. So it can, the license can be renewed every 10 years. Archon Radio has renewed the license with the FCC twice at a minimal cost. Because it expects cash flows to last indefinitely, there's the indefinite life intangible. Archon reports the license as an indefinite life intangible asset. Recently, the FCC decided to auction significantly more of these licenses. So there's the potential impairment event, right? Because they paid $2 million for this license. They think they're going to be, the main radio station in the market. And remember, these radio stations are making a lot of their money through advertising and so on. So if a whole other bunch of radio stations or licenses are issued, that means that advertisers could go, all over. So there's the potential for a loss of future benefits. So since the FCC is auctioning more of these licenses, there's an impairment event, right? As a result, Archon Radio expects reduced cash flows for the remaining 2 years of its existing license. So it's saying, even though we're going to renew the license again in 2 years' time, we have to take the loss now because this is the period in which the loss is happening. Okay, it performs an impairment test and determines that the fair value of the intangible asset is 1.5 million. Now, remember, this is an indefinite life intangible, so there was no amortization of this intangible. So the carrying amount of this asset is going to be the same as its cost. Okay, carrying amount is cost minus accumulated depreciation, but or accumulated amortization, but there is no accumulated amortization. So let's go through and see what they want us to do, and I'll do it on the screen with you. Compute the loss on impairment for Archon Radio. At what amount should Archon Radio report the license? If the fair value of the license increases, can Archon reverse the impairment loss? All right, so exercise 14, let's go. Please notice how you have to use the rules right in the theory to be able to answer these questions. So they're asking about, an impairment loss here in A. So we have to do, asking is, what is the impairment loss, right? What is the impairment loss? And we are going to do the fair value test. So you ask yourself, what is the fair value? That's 1 million. This was given in the question, 500,000. What is the carrying amount or book value, right? Same thing. It's going to be 2 million because there is no accumulated amortization, right? For an indefinite life intangible, cost is carrying amount because no amortization as indefinite useful life, right? The useful life will go on forever, so there's no way to amortize it because to amortize it, you need a number of years. So fair value is less than cost, so the asset is impaired and the loss is 500,000, which is obviously the 1.5 million minus the 2 million. Questions up to there? So one step, right? The fair value test is just one step, where fair value minus the carrying amount. But again, this is for an indefinite life intangible. You know, regular finite life intangible, you will do the two steps, the recoverability test and the calculation of the loss. So 500,000 is your loss. That's the answer to the first question. At what amount should Archon Radio report the license? The rules tell us over here that, where am I? Yeah, the written down book value becomes the new cost basis. So you're going to carry this asset at 1.5 million, right? You're going to write it down to 1.5 million is the new cost basis following the write down. And the journal entry would have been loss on impairment and credit the license, right? Because this is I'll do it here on the side in case someone was wondering. This was not asked, so don't panic. You didn't miss a part of the question. If I can spell journal, we can do it. So journal entry over here. If you were asked what's the journal entry, because this is an intangible, I'm just doing it so that you can see how it's different. So it's loss on impairment, same as before with our other example. But over here, you're going to put license or broadcast license or something, the actual name of the intangible asset. I'll give you a minute to write and people to think. Maybe there's questions that you have before we do part C. All right, so we can move on to C. This is the typical follow-up question now. If the fair value of the license increases, can Archon Radio reverse the impairment loss? Well, we go back and we see that it says recovery of the impairment loss is prohibited. So we say no. No recovery of the impairment loss is allowed. You can't do it. Once you take the loss, you're done, even if the fair value goes up. So that's a bit tough, right? I feel like sometimes the level of conservative accounting is a bit much, but that's how the FASB treats it. Even if circumstances change later, you're done. You took a loss, you keep the loss. Questions, anybody? Okay, so I'll give you another minute here for the people who are copying things down. We don't have to rush. You can take your time to copy it. Okay, so that's the end of indefinite life intangibles, right? It's a one-step process. Is the fair value less than the carrying amount? If that is the case, then there's a loss that's equal to the difference between the fair value and the carrying amount. And then the fair value becomes the new basis, the new cost basis of the asset. You cannot reverse any of the losses that you took, right? Then the last scenario with impairment is goodwill impairment. And like I said, goodwill is an indefinite life intangible, but because goodwill is inextricably linked to the operations of a company, like it's linked to a company, it's not its own separate thing like a patent or a trademark or whatever. You cannot look at goodwill in this way where you say, what's the fair value of the goodwill? Like, how much can I sell the goodwill for? Because you can't sell goodwill separately, right? You have to, goodwill arises as a result of selling a whole company. So as a result of that, goodwill is tested a little bit differently, because you don't say what's the fair value of the goodwill, you say what's the fair value of, they call it the reporting unit. So the part of the organization that the goodwill is in. So you say, how much is that worth? And how much is the book value or carrying amount of that? And that's how you do it, all right? So you don't say what's the fair value of the goodwill, you say what's the fair value of the reporting unit where the goodwill is located, and what's the book value of that reporting unit, and you compare the two. So I have good news, because over the weekend, as I was reading through the textbook again, and I was reading, prepping for the class, I realized that the FASB and by implication, the textbook has dramatically simplified the calculation of goodwill impairment. And I mean, in the past, it was like a whole big production, and you'll even see now when we do our examples that I'm going to follow the new approach, but the questions themselves are much longer now than they need to be, because there used to be this whole big calculation in step 2 of the process that is now no longer needed based on how things have been simplified. So that's good news for you. What it does mean is that I have to update the solution, manual that I gave you guys for all our class examples. I'll do the simplified approach on the working documents, right, on this document, but the solution manual still has this very involved 2-step process, which we don't need anymore. So I think that's a massive thumbs up. So just to give the overview then, to test goodwill for impairment, you're asking, is the fair value of the reporting unit less than the carrying amount or book value of the reporting unit, including the goodwill? And if that is the case, then the loss is just going to be the difference between the fair value of the reporting unit and the carrying amount or book value of the reporting unit. That's the loss, but the loss can't be more than the book value of goodwill. Okay, there's a cap on the amount of loss that you can take. So I'll go through, the write-up here, and then we'll do, 1 or 2 examples to just make sure that people are okay with us. But, it's kind of like, the recoverability test, right? In a way, because you're looking at fair value versus book value, but again, it's a reporting unit as opposed to goodwill itself. So goodwill is a unique intangible asset that is recorded only when one company acquires control of another company. Thus, by its nature, goodwill is inseparable from the particular reporting unit of the company. This is what I'm saying, that it's inextricably linked. And by reporting unit, they just mean like some part of the company's operations. So maybe Amazon buys Whole Foods like they did, right? So the goodwill that comes about as part of that purchase is linked to the operations of Whole Foods. So if you want to see whether that goodwill is impaired, you have to look at the fair value of Whole Foods right, versus the book value or carrying amount of Whole Foods and see, right, if the fair value is less than the book value. If that's the case, then goodwill may be impaired, and then you do a calculation to see if it is. So if you think about your reporting unit, maybe it's easier to just think of like Whole Foods as part of Amazon. That's a reporting unit. A reporting unit is an operating segment of a company or component of an operating segment for which discrete financial information is available. Whole Foods fits that definition. And a segment management regularly reviews the operating results of that component. So yes, management of Whole Foods is obviously regularly reviewing their operations. A goodwill impairment loss is indicated when the fair value of the reporting unit is less than its book value. We're saying that let's say Whole Foods can, if you're trying to sell Whole Foods as a reporting unit, you are going to get less, right, fair value. You're going to get less money for Whole Foods than the amount of that you're carrying it at on your books, the amount of book value. So let's say our books say that the net assets of Whole Foods is worth 10 billion, for instance, assets minus liabilities is 10 billion. But when we go and see how much we actually value Whole Foods at, it could be through a valuation calculation, it could be through a potential sale, etc. It's maybe only 9 billion. Then that means that the fair value is less than the book value, and so we have to take a loss, but the loss is limited to the amount of goodwill. Okay, a goodwill impairment loss is indicated. I already said that, sorry. Reversal of a prior impairment loss is not allowed. No surprise there. We've had the same theme all along, right? All three examples. Once you take the loss, you're done. And again, this is also why you might find when you're working in practice, if there is, indicators of impairment, management may not be as amped to take an impairment loss, because if often business people always like, oh, but the circumstances will change, things will get better. You think of this in the context of Facebook that bought WhatsApp and had 16 billion of goodwill. There was a time when they were like, oh, they think that they're still going to realize that amount of value, so they're not going to take any type of impairment loss. And part of the reason is also that once you take the loss, you can't reverse it. So your books are going to look pretty bad for at least one accounting period, because you're taking this massive loss. Okay, so here goes the two-step process. Compare the fair value of the reporting unit to the carrying amount, same as book value of the reporting unit, including goodwill. If the fair value of the reporting unit is more than the carrying amount, then goodwill is not impaired, right? If fair value, meaning what I can sell this thing for, is more than what I'm carrying it on in my books, I don't care. I'm stopping there. Goodwill is not impaired. But if the fair value is less than the carrying amount, right, then goodwill may be impaired, and you have to move on to step 2. And so in step 2, it's just repeating again. If the fair value of the reporting unit is less than the book value or carrying amount, a goodwill impairment loss is recognized for the difference between those two amounts. So you have to subtract the book value from the fair value. But the loss cannot exceed the book value of goodwill. So if I calculate, a $500,000 loss over here in this bullet, but the book value of goodwill is only 200,000, I'm only allowed to take a loss of 200,000. Because remember, the purpose of this whole activity is to figure out the impairment of goodwill. So you can't take losses more than what the goodwill was that you recognized in the first place. And then the journal entry is just debit loss on impairment and credit the actual asset goodwill. Okay, there's no accumulated amortization or anything like that for goodwill. If you downloaded the notes when I updated them for November the 2nd, this step 2 is updated for the simplifying of the calculation. So everything that I highlighted in yellow, I updated it over the weekend to make sure that I was giving you the simpler calculation that the book has reverted to, right? So don't panic if you print the stuff before and you see information that looks different to what I'm busy with. This is what you should be following, okay? And trust me, it's much easier than what we had before. So it's actually a blessing that this is happening. All right. So questions on the theory before we look at an example here? All right. So like I said, some of the goodwill examples that are on my documents are going to be a little bit more involved than they need to be because of the simplification of this calculation. But I'll take you through the whole process so that you can understand what's going on. Okay. So I'm looking at exercise 15. So the way this exercise is built, we've got, first round of scenarios where, there's no surprise here, where goodwill is not going to be impaired. And then we have a second round where goodwill will be impaired. And I'll take you through, what all of that means. So let's read here. Goodwill Corporation has 3 divisions. Okay. Unfortunately, the PRIT division experienced operating losses over the last 3 quarters. So if there's operating losses over the last 3 quarters, that would be an indicator of a potential impairment of goodwill, because remember, goodwill is something that you are paying because you believe that this, whatever you invested in is going to generate a whole lot of revenue for you and it's going to be profitable, right? Future benefits. But now if this division has operating losses, it's an indicator that goodwill may be impaired. Goodwill management is now reviewing the division for purposes of recognizing an impairment. So they're doing the right thing. PRIT division's net assets, this means assets minus liabilities, including the associated goodwill of 900,000. So there's one of the things that I said we need, with this simplified approach to goodwill impairment. This is the book value of, or the carrying amount of goodwill, right? It's 900,000. It's also shown over here, 900,000. We need this amount because we have to remember that any impairment loss that we calculate cannot be higher than 900,000. From the purchases are shown below. So this is all the assets, right? And then you've got your accounts payable is a liability. So that was a 2.4 million net assets, that they purchased some time back. Questions on the first part of the exercise before I go into the rest? Okay, so if Colby determines that the fair value of the PRIT division is 2.8 million, right? Oh, this probably shouldn't be if, it should just say Colby. The recorded amount for PRIT division's net assets, excluding goodwill, is the same as the net assets fair value, except for inventory, which has a fair value of 20,000 above the carrying value. So now this amount, this information over here, based on how the work has been simplified to some extent, is somewhat less relevant. I'll show you that when we do the calculation, we don't really need it. What we need is the book value, which is this, right? It says the book value of the net assets, and we need the fair value. And, we'll compare the two to see whether there's any goodwill impairment. So in A, determine whether goodwill is impaired, and in B, if there's an impairment, calculate the impairment, prepare the journal entry. No surprises in that flow of requirements, but it may be that there's no impairment. So let's do steps here to solidify that we actually understand the theory. So it's exercise 15, right? It's going to be a goodwill impairment, simplified goodwill impairment, right? So the step 1 is the fair value of the reporting unit less than its book value, right? That's the question that you're asking. So let's say, what is the fair value of the reporting unit, right? We can write these numbers out. So because there's a lot of things floating around, we want to make sure that we're not missing anything. What is the book value of the reporting unit? And this is the book value including goodwill, all right? So going back to the question, the fair value is 2.8 million, all right? So we've got that, 2,800,000. And the book value of the reporting unit, we have it here. It says PRIT division's net assets, including the associated goodwill of 900,000 from the purchase, are shown below. They've, depreciated whatever they needed to depreciate. And this is the 2.4 million is the book value of the reporting unit. So I'm going to go with 2.4 million. And that's including goodwill. So what do we see? Is the fair value less than? No, right? Stop. As goodwill is not impaired, right? Don't do step 2. So that's the answer to A. And that's the answer because the fair value is greater than, not less than, the book value of the reporting unit. Questions here, anybody? Okay, so in B, then this becomes irrelevant, right? Because the goodwill is not impaired. So B, you'll just say not applicable. Oh, let me write this right there. Let's write it on here. Not applicable as goodwill is not impaired. All right, so you're done. And so there was a lot of information given. This is what I meant now when I said that for some of the previous, examples with goodwill, we had a very involved step 2 that we had to do. And as a result, we ended up needing all this other information, which right now we just don't need. So exercise 15 is not done, because now we move on to this other example here, or other scenario. So Colby determines that the fair value of the PRIT division is 1.9 million. Everything else stays the same. It's asking us to determine if goodwill is impaired, right? So you're basically going through the same process again. And so I'm just going to take, this information here. I don't know that many people are writing along with me, but I'll stop so that you can catch up. But the question remains, right? Is the fair value of the reporting unit less than its book value? That's the first question that you ask when you are faced with goodwill impairment. And so now the fair value has changed to 1,900,000, right? The book value is still the 2,400,000 from before. So now we see that, yes, the fair value is less than book value, right? Yes, so goodwill may be impaired. And the reason we say maybe is that we still have that second step where we calculate the actual impairment and limit it to the book value of goodwill. So, we don't just say goodwill is impaired. We actually have to double check that we come up with an impairment dollar amount. Okay, and so the next part, D, if goodwill is impaired, calculate the amount, prepare the journal entry to record the impairment. So here goes step 2 is the impairment loss, right? Calculation. And what we are saying is we're basically just bringing this information down, and we're saying, well, let me actually write out what I'm going to do. It's just going to be the loss is the difference between the fair value of the reporting unit and its book value or carrying amount. Again, remember, book value and carrying amount mean the same thing. So bring this down, right? Fair value, book value. So the amount of the loss is going to be 500,000. Note that the loss cannot exceed the book value of goodwill, which is 900,000, and that's given in the question. you may have to calculate it. It really depends on the question. So it doesn't exceed 900,000, so we're okay, right? The loss is 500,000, doesn't exceed 900,000, so we can go ahead and make the journal entry. Let me stop there though and check if anybody has questions on how to calculate the loss. If you're following on the solutions spreadsheets, remember I told you that the previous solution was way more complicated than this one. What I'm doing, sorry, there's a typo here. What I'm doing is following the much simplified approach in the book, okay? So I'll fix the solution to mirror what I'm doing over here. Any questions? Okay, so the next piece is, you know, what's the journal entry? No surprises, loss on impairment. And it's going to be 500,000. Again, if you're looking at the previous example, because of the way those examples will work, the loss there is 520, but we go with 500, we go with the simplified answer, okay? Loss on impairment, 500,000, goodwill credit, 500,000. Questions, anybody? I'll give you some time to whoever's, I know a few people are taking notes, so if you need to write stuff down, go for it. Okay, so it seems like hopefully everyone's had enough time to write this stuff down. I'll do this one with you also because this one does the actual calculation of goodwill amount and then the impairment and then the journal entry for the impairment. So we can do this. It looks way more involved than what it's going to be, so don't panic. I'll walk you through it. And then after that, I'll just wrap up some of the other there's just a few more small things to say in the chapter before I go over the test prep sheet, okay? So exercise 16, again, looks heavier than what it is, but you know, I'll make sure that we go slowly. On July the 31st, 2014, Mexico company paid $3 million to acquire all of the common stock of Conchita Incorporated. So there's a one company purchasing another company, which could result in goodwill, right? And Conchita became a division of Mexico. Conchita reported the following book value of net assets at the time of acquisition. All right, so book value of net assets at acquisition was current assets 800,000. You have some non-current assets and then liabilities to give you a net asset of 2.4 million. It's just coincidental that it's the same net assets as the previous example. The examples are not related. All right, so that's the book value. But what we know, and this is where you have to be careful because this is basically where you have to try to combine your knowledge from chapter 10 and chapter 11. When you are calculating goodwill, you're looking for the fair value of the identifiable net assets as the amount that you will compare to the purchase price to actually determine how much goodwill. You don't look at book value for initial goodwill calculation. All right, so that's a little bit difficult. So I'll repeat. Two things are happening in this question. The first thing is that the one company is buying the other company, and we have to calculate the amount of goodwill, right, that is actually being generated as part of that purchase. The second thing that will happen is that goodwill becomes impaired. All right, so then we'll calculate impairment, and I'll do both with you. Over the next 6 months of operations, the newly purchased division experienced operating losses. So there's you can already guess where this is going. In addition, it now appears that it will generate substantial losses for the foreseeable future. At December 31st, 2014, Conchita reports the following balance sheet information. So this is at December 31. Remember, the previous one was at July 31 when they were buying the company. So 6 months later, net assets have dropped now to so this is book value, all right? If anyone's still in any doubt, the net assets shows the book value of the company, 1,650,000. So they've gone down from the 2.4 million that they, had when at the date of purchase to 1,650,000. It is determined that the fair value of the Conchita division is 1.6 million. All right, so that's going to be needed when we're doing the goodwill impairment, looking at that piece. The recorded amount for Conchita's net assets, excluding goodwill, is the same as the fair value, except for the property, plant, and equipment, etc., etc. What you can literally do here is trying to see if I can find it now. We don't need this information anymore because of the simplification with the calculation. This information is extraneous. It's not needed. So, if it helps you, I'm doing that so you don't have to rack your brain to try and figure out what it means, okay? Because we no longer have to recalculate the fair value of the net identifiable assets, which is how we used to do this calculation. So in A, it says compute the amount of the goodwill recognized, if any, on July the 31st, 2014, the date of the purchase. So we have to go back up and look at all the purchase information and do that. Then in B, it asks you to determine the goodwill impairment loss, if any, on December 31, 2014, and prepare the journal entry for the impairment, right? So let's see how far we can get here with exercise 16. The first stop is to calculate goodwill, right? Goodwill itself. So it's a goodwill calculation, not a goodwill impairment. Just want to. So how do we calculate goodwill? It's going to be the purchase price. And again, this is coming from chapter 10. So maybe, I'm sure there are examples in chapter 11. I think there's maybe even one, worked in the textbook, but there are examples where goodwill is being calculated. But we did learn this in chapter 10, okay? So it's the purchase price less the fair value of identifiable net assets, right? Equals goodwill, all right? And the fair value of net identifiable assets means the fair value of the assets minus the fair value of the liabilities. But in this question, they give us one number. So purchase price was 3 million. I remember that from the question. But let's go back and see about the fair value. So purchase price right up here, 3 million. The fair value of the identifiable net assets is given. It's 2,750,000. You don't go with this because this is book value, okay? So 2,750,000. They don't tell you fair value of assets and fair value of liability. So you just take this number by itself. So the goodwill that is generated from this purchase is 250,000. So that's the answer for part A. Goodwill is 250,000. Questions, anybody on A? So for B, determine the impairment loss, right, to be recorded on December 31st. So we know already that we go through this two-step process, right? The fair value of the reporting unit has to be less than its book value for goodwill to possibly be impaired. So this is going to be goodwill impairment. And you ask, what is the fair value of the reporting unit, right? What is the book value or carrying amount of the reporting unit? And we'll get these answers from the question. So the fair value is given here as 1,600,000, right? That's the fair value of the reporting unit. 1,600,000. The book value of the reporting unit is given at December 31. This balance sheet information, net assets, that's the book value, that's the carrying amount, okay? 1,650,000. Is the fair value less than book value? And the answer is obviously yes. So goodwill may be impaired. And then remember, this is step one. And then my typing is not catching up today to my brain. And then in step two, we're going to calculate the impairment loss, right? And it's just going to be, we already know this, it's going to be the difference between the fair value of the reporting unit and the book value. So the loss is going to be 50,000. And remember that loss is limited to book value of goodwill, calculated as 250,000 in A. So there's no problem because obviously 50,000 is not bigger than 250,000. So your loss will be 50,000. Stopping there so people can write and ask questions if you have questions. And again, remember, this simplified approach is going to result in different questions from what you have on the solution sheet. I'll fix the solution sheet so that it can reflect the simplified approach. Any questions? Okay, so that was B. And in C, prepare the journal entry for the loss, if any, right? So it's going to be the same as before, right? Loss on impairment is the debit and the credit is goodwill. 50,000 and the credit is goodwill. The same. All right, so that's a different example where you actually and number 17 is the same. Basically, you're basically calculating the goodwill in part A, and then in part B and C, you're dealing with the impairment. So you just, the purpose of part A is obviously to test to see whether you know how to calculate goodwill, and you have to remember that it's the purchase price minus the fair value of the identifiable net assets, not the book value. And it's the fair value of the identifiable net assets of the company being acquired, right? Obviously, I know this seems really obvious, but I've seen examples in the book where they give you both companies' fair value, and you have to make sure that you understand that it's the fair value of the company being acquired, and it's fair value, not book value. And then with goodwill impairment, you're looking at the fair value of the entire reporting unit, comparing that to the book value of the entire reporting unit. I know this is tedious to keep writing things out, but I found with these examples that it's somewhat, I think, better to just write out the information that you have and have it, on a sheet and you can look at it, as opposed to thinking about it in your mind. And there's so many different numbers rolling around, and you need to remember to limit the loss to the amount of goodwill. So, you could end up getting really confused or getting to the wrong answer. So maybe just follow, be systematic in terms of the steps that you're taking. Any other questions or comments here? All right. So like I said, 17 is basically the same as 16. It's just extra practice with the same questions and everything. So, if you want to practice, you can. I just want to wrap us up here. There's a small piece in the textbook about assets held for sale. So an asset that, you're not using. So that means you're not depreciating it. And that should, so how do we test for impairment, right, of an asset held for sale? We don't have examples on this. It's a very small topic. But basically, it's saying that if an impaired asset is intended to be sold, held for sale, it is reported at the lower of book value or fair value minus cost to sell. So remember, fair value minus cost to sell is basically almost like a net realizable value. So an asset held for sale, you have to compare the book value of that asset to its fair value minus any cost to sell, and you will record it at the lower amount, because it's saying, the amount that you carry the asset at in your books can't be higher than what you can actually get for the asset if you are planning to sell it, because then the asset is overstated. So if the asset is held for sale, find out fair value, subtract any cost to sell, compare that to the asset's book value, and that will tell you if you need to take an impairment loss or not. And you do this every reporting period for as long as you have still not sold the asset. And there's no further depreciation because you are not using the asset. So you can't, depreciate assets that you don't use. Using the asset is a fundamental requirement for depreciating an asset. In fact, if you prepare taxes, and a company buys an asset but doesn't place it into use before the end of the year, they're not allowed to take depreciation for it. It's the same for accounting. All right. So that's assets held for sale. Again, minor topic. In fact, I don't know if the textbook is still, if it's not going to throw me out. Let me show you. That's the extent of the section. Okay, so don't panic. There's really nothing there. I did want to just point out that there is an illustration 1125. If you feel like everything is just like in your head, what is going on? The impairment tests that I've just been teaching you are all nicely, I guess, summarized in this illustration 1125 in the textbook. So perhaps that's on page 609. So perhaps, that might be a nice reference guide for you as well. And then, the last piece here of the chapter, I found it a little bit awkwardly placed, but maybe it was just me, that they're just talking about subsequent expenditures that you make on assets. And, they're talking about, are you, paying money for maintenance or repairs, or are you doing extensions or additions or, rearrangements, as one of the items is called. And so the thing that we want to remember here is we either capitalize, so make an asset out of these items, or we expense them, right? Those are our options. It's either going to be an asset or an expense. I know it's called subsequent expenditures. They are all paid out, as expenses, but some of them can actually be made into assets. And the way you think about whether something should be made into an asset is, the future benefits are increasing, right, by making this payment. So it's an extension of the useful life of the asset. The asset becomes more efficient. or whatever the asset is producing is getting better. Those are the types of things that will make you capitalize the payment that you made. And the book actually, you know, and I just tried to summarize it for you guys. The book actually says what you would expect anyway, that repairs and maintenance are an expense, right? When you pay to repair or maintain something, you're basically just keeping it at the same level that it was before. You're not actually improving anything about the asset. If you change the oil on your car, or you change, you know, brake pads or something, it's an expense, because it's not it's just bringing the asset up to the point of regular functionality. If you add on something, right, you add a piece onto your house, or you add something into your car, you put in an engine that is way more advanced, or whatever the case may be, that you can capitalize, because that's improving the future benefits that are coming from the asset. Improvements, as the name implies, will also be capitalized. So you know, whatever you are doing to actually improve the asset to the point that either its useful life increases, or it's more efficient, or something like that, that is going to be capitalized. And then a rearrangement of an asset, you know, it's a little bit of a strange concept to think about. Like, you know, you're probably going in and redesigning a space, or redesigning, you know, maybe the way a machine should work, or something. Something is not necessarily being added, but there's a way in which what already exists is being changed around so that it is working better. And so in that case, again, if it's a material rearrangement, right, that's what they say. If it's material, meaning it's really changing the way the asset is functioning, then you can capitalize it. And why do we care? Because there's a lot of potential for error and, unfortunately, fraud if we make mistakes. I think right at the start, when we started chapter 10, I told you about WorldCom and like the $2 billion fraud where they were making things into assets that weren't supposed to be assets. So, you know, there's the potential for big amounts of money going to the wrong places. So we as the accountants need to know where the different types of expenditures should go. And then, of course, this last piece, you know, we spoke about this already at length. We even had an example about this of successfully defending an intangible. That will be capitalized as well. So if you have a patent and you go to court and you have to fight someone in court because they infringed on your patent and you win, those legal expenses can be capitalized onto the cost of the patent. Same with a copyright or whatever other intangible you're dealing with. So that's the subsequent expenditures. There's a very simple example on that. You already have the answer, so I'm not going to belabor that. I just wanted to at least round out the chapter for the people who are on top of things with doing the homework. You do still have, until the 10th to do the homework. So on Wednesday, when we get together, I'll do that simple example for subsequent expenditures and finish the last example for this chapter. And then we'll move on to the next chapter, which is investments. Okay. Any points or anything that someone wants to ask or say before I revisit the test prep sheet? All right, so again, we'll revisit this on Wednesday. And of course, in between that, today I have office hours from 1 to 2 if people have questions on the homework or questions on anything. And you can also email me with questions. All right, so let me go back here again, just to reiterate that homework due on Wednesday. It's due after the class happens, so you can still ask me questions on that. And then for the test and the quiz, I hope I've fixed this properly now. So this is the test 2 and quiz 2 information. It opens on Thursday. think Thursday is a public holiday, but it's not a CUNY holiday. So I know I don't see you on a Thursday, but you definitely, you know, if you have classes, you will have Thursday classes. It opens on Thursday, November 11 at 9 a.m. and closes the following Thursday at 6 p.m. So it's similar to what we had before. It's available on McGraw-Hill Connect. So it's the same process as before. It's also 15% and 3% like the previous quiz and test. That's why I copied the information across, but I forgot to make some updates. No deadline extensions or makeup tests without a valid documented excuse, because remember, you have 1 week to do this. So, you know, something must have happened. I can't just take extensions for the sake of extensions, especially also as we're around the corner towards the end of the semester. As of, you know, today, we're 4 weeks out from the last day of class. The last day of class is December 8th. You know, please note that it's a timed, you know this already, it's a timed situation. So you, even though you have a week in which to do it, once you start it, you have to complete it within the time allocated. There's no pause button. So you need to make sure that you have a proper internet connection, your computer's charged, you don't have people running around in the house driving you cuckoo or whatever, or you can go to LaGuardia, to the library to sit and do it, whatever the case may be. Just make sure that you have a proper setup to get it done. I'm also still encouraging people to do the quiz before attempting the test, because it gives you an indication. It's lower stakes, right? It's only 3%, and it gives you an indication of the types of things that are being asked. You have 3 attempts still, same as before. I dropped the penalty by even more, okay? The penalty previously was 20%, and I immediately dropped it to 4%, and now I'm dropping it to 2%. Just remember that the system is weird, that, you know, I expected that the system would only take the penalty off of the question that you're trying to fix, but it actually takes it off the whole question. So let's say you do the quiz and you end up with a 90. If you go back in, you automatically are on 88%, all right, even before you try to fix your answers or whatever. So just be aware of that. Every time you do an additional attempt, it's going to take 2% off the total score, not just off the questions that are wrong, which, you know, is very frustrating to me, because you have questions that were right, but there's nothing I can do. That's how McGraw-Hill set up their system. And then for the test, I'm only taking a 4% per attempt. It was 6% before. I'm just trying to give some more grace, you know, as people try to get as many points as possible. Same setup as before. The quiz is 10 multiple choice questions. It's focusing on calculations, journal entries, you know, financials. It's not definitions. I'm not asking theory questions on this quiz. The quiz is hardcore, you know, calculating and things, because you need to see if you actually know what you're doing. On the test, it's a combination of calculations and theory. So you do need to be ready to answer questions that are actually, you know, word answers as opposed to just numbers or journal entries. So there's also 10 multiple choice questions, same as before, and 4 or 5 exercises. I'm not done yet, so I need to see, you know, especially with the depletion and depreciation stuff, how I can split those exercises. There's definitely asset acquisition and non-monetary exchange exercise, interest capitalization, depreciation, depletion and amortization calculations. All the methods for depreciation and, you know, amortization and depletion are straight line and units of activity respectively. Partial period depreciation, you need to know how to do that, and then a journal entry for depreciation. Impairment, we just finished that for property, plant and equipment, and finite life intangibles. So we just did that, and also goodwill impairment. If anything changes here, you'll know before Wednesday. And by change, I just mean that maybe I'm not going to ask something, you know, in such detail, whatever, I'll tell you. I'm not necessarily changing the topics that I'm putting in. And then I listed here the topics that are covered, because I'm just thinking that maybe it could help you make sure that you actually studied everything, but you can also follow the handouts. They have all the headings for different topics. There's a lot of small topics here, and so I wrote out everything just for those people who do want a checklist, right, to check that everything is covered. So the types of assets, which costs should be capitalized for each asset. We went through all the different PP&E, natural resources. There was the asset retirement obligation and so on. I'm not going to read every single thing here because I think it will become a little bit overwhelming to just have someone reading a laundry list of things to you. I know this looks long, but if you go through, you'll see that it's parts of different topics. I just try to be very specific to make sure that you know what the topics are, because remember, if they don't come up in the exercises, they're going to come up in the multiple choice questions, right? So I may not ask you, let's see, I may not ask you about dispositions as an exercise, but I could ask you that in a multiple choice question. That's what I mean. So I don't want you to ignore topics that are not being shown as exercises over here. All right, so I still reserve the right to make a few changes here and there as I seal the deal on the test. But for the most part, this is where my mind is at. Does anybody in the minute that we have left, anybody have anything that you want to ask me about the test and the quiz? I mean, you can speak for more than a minute. I'm just saying that I need to at least leave time for any questions. No? All right, guys. So I'll see you on Wednesday. Ready for the end of chapter 11, which is really just probably going to take 10 minutes, and then the beginning of chapter 12, which is investments. I would highly recommend that you are here for that chapter, because you did not do investments yet as part of the sequence in accounting at LaGuardia, so it's going to be something very new. Okay, so talk to you then. I'll still stay on the line if people have questions. Otherwise, I may see you in office hours.